Cool. Okay, good morning and thank you for joining me online. I'm sorry that we had to cancel the face-to-face lectures for those of you who signed up for that. Apparently there have been too many COVID cases under the from the students. So just to be on the safe side, they've decided to cancel all the face-to-face lectures. So, but it doesn't matter. You guys are very chatty on the group, much more so than when I meet you in person. So it's good to see that accounting sciences students do actually have personalities. I knew they did, but sometimes when they sit in front of you in a class, it's difficult to see that. Okay, so today we start with leases, with IFRS 16 leases. And I asked you to have a look at class example 1, which is just a revision example of many aspects from IFRS 16 for the lessee. Okay, so if we look at that, first of all, if we look at this, how the standard is set out, you will see that we start off with the standard starts off with the objective and the scope, and that's general for the lessee and for the lessor. Then we have some recognition exemptions that only apply to the lessee. So my color coding over here, you'll see my lessee is in red and my lessor is in green. So the recognition exemptions, they only applies to the lessee. And then the standard tells us about how we have to identify the components of a lease. Okay, so how to identify the different components of a lease. It also tells us how to identify whether a transaction is a lease transaction or not, but that we only do in CTA next year for you guys. Okay, then we also get information on the lease term. So all that is still general for the lessee and for the lessor, and then the standard goes into the lessee specific requirements, dealing with the initial recognition, then the subsequent measurement, as well as presentation and disclosure, and then we will add to that the tax treatment for the lessee. Okay, so that's our plan for this week. To look at the specifically what we are going to look at is we are going to look at first just general revision, then we are going to focus on the tax treatment. That's part of our lecture for today, and we'll carry on with that on Thursday. And then we're also going to look at subsequent measurement. There are some subsequent measurement issues that you have not yet dealt with in FRK 201. So basically, the bulk of the lessee you've already dealt with in FRK 201. We are just adding some things to it. And then for next week and the week after, we will be jumping into the lessor. Okay, so that's our plan. So, okay, and then also, yeah, very important. Remember that for IFRS 16 in Appendix A, we have all our definitions. That's very important that you know where to find those definitions. And then also do not forget about the B paragraphs in Appendix B of IFRS 16. Okay, many important concepts are explained in the B paragraphs. Good. So if we look at example 1, I asked you to have a look at that example, do it at home. So I'm just going to touch on some of the issues in or some of the things in that class example, link that to the theory, and then with the main purpose of just making sure that you revise what you know what you did in FRK 201. We revise that again. But if you have any issues or questions with regard to class example 1, then please just post a comment. Good. Okay. So when we first start as a lessee, we start with the lease transaction. We start by calculating what our lease liability is going to be. So this is going to be, our journal entry is going to account for this lease is going to be to debit the right of use asset and to credit a lease liability. But we start our calculations with the lease liability. Sorry, I just see there's a question from Mr. Schrempel regarding the CEV1 scope. Yes, everything up until Thursday's lecture is included in the scope for the CEV, next week's CEV. Good, so not the lessor, just the lessee. Okay, so our initial recognition for a lease, we're going to debit the right of use asset and credit the lease liability. Now, how do we calculate that lease liability? Now, the standard tells us in paragraphs 26 to 28 that we have to calculate the present value of all lease payments not yet paid at the commencement date. So when we are calculating our liability, we are looking forward to see what are all the payments that I still have to make, and then I bring that back to a present value for today, and that's going to be our lease liability. So that's important. Everything that has not yet been paid, and if there are any lease incentives, then also the amount that have not yet been received. So if we look at what lease payments are, then we see that the standard tells us that for a lessee, important that there's a difference between the lease payments for lessee and the lessor. But for the lessee, lease payments consist of all the fixed payments, less any lease incentives still to be received. And here we have to watch out for the in-substance fixed payments, because sometimes a payment seems as if it's going to be a variable lease payment. However, it's actually a fixed, in-substance fixed payment, because there's no way to actually get around paying it. You still have to pay that fixed amount. Okay, and then lease payments also include all variable lease payments, but only those variable lease payments that are linked to an index or a rate, specific rate. If that's the case, then we will include those variable lease payments in the measurement of the lease liability. But if the variable lease payments are linked to something like the machine hours or the units manufactured or anything like that, the kilometers traveled or whatever, then it's not linked to an index or a rate. So therefore, those variable lease payments will not fall within the definition of a lease payment. Okay, then important, the lease payment also includes the amount payable in terms of a residual value guarantee. So we'll look at what a residual value guarantee is just now again, but important that it says the amount payable in terms of the residual value guarantee. So not the full guarantee, only the amount that will be payable at the end of the lease in terms of that residual value guarantee. Then we will also include any amounts payable for the purchase option if it is reasonably certain that we are going to exercise that purchase option. And then any amounts payable in terms of a termination option if it is reasonably certain that we are going to exercise that termination option. Okay, so if we look at a residual value guarantee, then let's assume that our residual value guarantee is R8. So that means that I, as the lessee, I am giving a guarantee to the lessor that at the end of the lease term, when I give him his asset back, he is going to get at least R8 back from me at the end of the lease term. Okay, so I'm saying at a minimum, I will give you R8. So if it now happens that at the end of the lease term, the actual residual value, the value of the asset at the end of the lease term is R10, then you can see that we actually met that requirement of the residual value guarantee. The value is actually higher than the guarantee that we gave. So therefore, there will be nothing payable in terms of the residual value guarantee. Okay, so that's important, because at the end of this lease, I am giving the asset back. So the lessor is actually receiving an asset that is valued at R10, but my guarantee was that it won't go below R8. So what happens here is we actually, the lessor, if at the beginning of the lease term, the lessor says, okay, we expect the residual value to be R10 and the residual value guarantee is R8, then the R2 will be the unguaranteed residual value. Okay, so the unguaranteed residual value is the difference between the actual residual value of the asset and the amount of the residual value guarantee. Good. So we stick with our example where our residual value guarantee is R8, but now at the end of the lease term, we've actually used that asset quite extensively. So now the asset value is only R6. So what does that mean? We as the lessees gave a guarantee that the lessor is going to receive R8 at the end of the lease term. So what do? We give him the asset back of R6, and then we have to pay an amount cash in order to make up the R800 residual value guarantee. So the lessor is still getting his R8 at the end of the lease term, but he's getting it in the form of a R6 asset and a R2 cash. Okay. And in this situation, you will see now that we cannot have an unguaranteed residual value. In a situation like this, there will be no unguaranteed residual value, because if the lessor knows at the beginning of the lease that the asset is probably only going to be worth R6 at the end of the lease term, but the residual value guarantee is R8, then there is no portion, there's no unguaranteed portion, because the asset is actually going to be worth less than the residual value guarantee. Okay, so that's it on a residual value guarantee. Anyone have any specific questions on that? Okay, I don't see any questions there. So, but if you do, please just post that. We'll check at the end, or every now and again I'll check for questions. Now, good. Now we now know what let me just go back. Our lease payments consist of. And that's all the future lease payments that we are going to have to pay. We now have to discount that to a present value to measure what that lease liability's present value is. How do we do that? We do that by using the interest rate implicit in the lease. Now, this is the first price. This is the first price. This is the actual rate that we should always try to use, is the interest rate implicit in the lease. However, there's a problem with that interest rate. And the problem is that we as the lessee need to, first price is that if we can use that interest rate implicit in the lease. But the problem is that the interest rate implicit in the lease is calculated from the lessor's perspective. Okay, so that's why it's a green eye. So interest rate implicit in the lease is calculated from the lessor's perspective. So we need some information from the lessor in order to be able to calculate the interest rate implicit in the lease for the lessee. Okay, so that's the problem. We don't always have that information, because what the interest rate implicit in the lease requires that we calculate, or it says it's the rate where the present value of all my lease payments, which is the lease payments that lease payments in terms of the lessor definition, not the lessee definition, plus then the unguaranteed residual value, where the present value of that will equal the fair value of the asset plus the initial direct costs of the lessor. Okay, so the problem comes here. First of all, we as the lessee may not know what the initial direct costs of the lessor were. And we also might not know what the unguaranteed residual value for the lessor will be. So that makes it difficult for us as the lessee to calculate the interest rate implicit in the lease. Okay, now just on that, so to calculate the interest rate implicit in the lease, our present value will be the fair value of the asset on that date, plus the initial direct costs of the lessor, which we as the lessee will not necessarily know. We'll use our lease term as N, the payment will be the lease payment, and the future value will be the final lease payment, if there is any, plus then the unguaranteed residual value, which again, we as the lessee might not know. Okay, so just on the point of the lease payments, remember we said that the lease payment definition for lessee and for a lessor is different. So go and check that. These definitions are different for the lessee and for the lessor. So for the interest rate implicit in the lease, we use lease payments from the perspective of the lessor. Now, what is the difference here? If we check now what's included and lease payments for the lessee versus the lessor, we see that, okay, fixed payments, less lease incentives, yes, that's the same. Then all variable payments, yes, that's the same. And now with the third one, we get our issue here, the difference between the two. And that is for the lessee, we will only include the amount payable in terms of the residual value guarantee, whereas for the lessor, we include the full residual value guarantee. So there's our difference between the lease payments for the lessee and the lessor. All the other amounts, again, agree. It's just with regards to the residual value guarantee that we have a difference. Okay. Let me just audit Mr. Armstrong here. And who else gave answers? And I'll just check the questions. Please could you repeat why there's no unguaranteed? Okay. So Mr. Armstrong said the value of the asset is less than the residual value guarantee. Does that answer your question? And Ms. Marie, I think, said yes. Slow down. Yes, cool. Okay. Yes. So because the asset is less than the residual value guarantee, unguaranteed residual value is the extra portion of the residual value that has not been guaranteed. So if the asset value is smaller than the residual value guarantee, then it means there is no unguaranteed portion. However, if the residual value is bigger than the residual value guarantee, there is an unguaranteed residual value. Okay, can't the unguaranteed residual value not also arise where the lessor anticipates it will be able to sell the asset for an amount above the residual value guarantee? Yes, exactly. So that's where the unguaranteed residual value comes from. If we go back to that slide, so that's Ms. Wannapool, that's the situation we have here, that the lessor says, I think I'm going to be able to sell this asset at 10 Rand at the end of the lease term. The residual value guarantee that I have from the lessee is 8 Rand, so therefore unguaranteed portion is 2 Rand. I have no guarantee with the residual value guarantee. This is written into the contract, so that's why it's guaranteed. I know at the end of the lease term I'm getting at least 8 Rand. But if I think the asset value is actually going to be bigger than 8 Rand, more than 8 Rand, then it means there's a portion that's unguaranteed. But I looked into my crystal ball and I saw that I'm probably going to be able to sell this asset for an additional 2 Rand over the residual value guarantee amount. Okay, does the unguaranteed residual value affect the lease liability calculation? Yeah, so that's the interesting question. So it does not directly affect the lease liability calculation. However, it will affect the interest rate implicit in the lease. So that means it is going to affect that calculation in terms of the rate that is used to calculate the present value. Okay, so if we have that information, if we know what the unguaranteed residual value is, if we know what the initial direct costs of the lessor were, then we can actually then we can use the interest rate implicit in the lease, which means that the unguaranteed residual value is going to affect the measurement of the lease liability. However, it does not affect, if we go back to this picture, it does not affect the actual lease payment. In the actual lease payment, where we put in our present value, future value, payments, etc., we're not going to have the unguaranteed residual value over here, but it might affect the rate. Good. Or it is going to affect the rate if we are able to use the interest rate implicit in the lease. Good. Is the payable residual value guarantee referred to under lessee only the unguaranteed portion that needs to be included? Is the payable residual value guarantee referred to under lessee only the unguaranteed portion that needs to be included? I'm not sure if I understand your question. The amount payable in terms of the residual value guarantee is the unguaranteed portion that needs to be included. Ms. Lewis, I'm not sure if I understand your question. we are saying here so the amount payable in terms of the residual value guarantee, that's R2. That's the unguaranteed portion that needs to be included. Now, the R2 is part of the residual value guarantee. I will only have an amount payable in terms of the residual value guarantee if my actual asset value, the residual value of the asset at the end of the lease, is lower than the residual value guarantee. So at the end of this lease term, the lessor knows that he's going to get R8 back from the lessee. And in this case, that R8 is made up of a R6 asset and R2 cash. So in this case, there cannot be an unguaranteed residual value, because unguaranteed residual value will only be the amount of the residual value over and above the residual value guarantee. Okay. Let's see. Oh, okay. I like all your questions. It keeps me on my toes. The unguaranteed residual value allows the lessor to sell at the higher price while not receiving additional payment from the lessee. Yes, because you are now referring to this situation where the lessee is just bound by the R8 and this R2 is over and above the residual value guarantee. Okay, so just to be sure, the R8 is what I read now, the R8, and I was thinking, why are you talking about automatic guns in the chat? But I realize now it's R8. The R8 is what we'll use as the future value when calculating the interest rate for the lessor. But for the lessee, we use the R2 as the future value if the asset is worth R6. Okay, so you're talking about this situation. So what's happening here is for the lessee. So the lessee is going to include this amount payable in terms of the residual value guarantee as the future value. So that will be the lessee. However, if we for the lessor. So the lessor, in order to calculate the interest rate implicit in the lease, the lessor is going to include the R8 as the future value. Yes. Okay. What the difference between the lease payments for the lessee and the lessor? That's exactly what I just spoke about. So what we are saying is for the lessee, we include the amount payable in terms of the residual value guarantee as the future value in our calculation to calculate the lease liability. However, for the lessor, you'll see next week when we do the lessor as well as now for the calculation of the interest rate implicit in the lease, we will use the full residual value guarantee as our future value to calculate the interest rate implicit in the lease. So that's the difference. All the other amounts are the same. It's just the fact that the lessor actually includes the full residual value guarantee, whereas the lessee only includes the amount payable. So if we had this situation, there was actually, in this situation, there was no amount payable. No amount payable in terms of the residual value guarantee, because the lessee is actually giving back an asset that's worth more than the guarantee. So there's no amount payable. So in this case, the lessee will have R0 in its future value in terms of the residual value guarantee. Whereas for the interest rate implicit in the lease, the lessor will include the R8 residual value guarantee as well as the R2 unguaranteed residual value. So effectively, the lessor is saying, okay, at the end of this lease term, I am getting an asset back worth R10. Okay. One more question here. It is the difference between residual and the actual value. Okay, I think I answered that. So if the asset value is the same as the guaranteed residual value, the amount included in lessee payment is 0 and the lessor will include the guarantee amount. Yes, the guarantee / full residual amount, yes. In that case, two amounts are the same. If there was a purchase option, lessee party is planning to buy it, what would the future value to calculate the interest rate be? Okay, so obviously, if we are now calculating the interest rate implicit in the lease, that's now done from the lessor's perspective. So if there's a purchase option, and from the beginning the lessee said that they are going to purchase this asset, then that means that obviously there will not be an unguaranteed residual value, because the asset is going to stay with the lessee. Okay, there will also not be an amount payable in terms of the residual value guarantee. There won't be a residual value guarantee because there's the purchase option that the lessee is going to exercise. So it means at the end of the lease term, there will probably only be a final lease payment. Yeah, so in that case, we won't have these amounts in our interest rate implicit in the lease, calculation of interest rate implicit in the lease. And for our lease payments, yeah, we will then have a purchase option. So if there's an amount payable at the end of the lease term for that purchase option, we will not have anything payable in terms of the residual value guarantee, because we're not going to give the asset back. When calculating interest rate implicit in the lease, wouldn't the lessor only include R8, the residual value guarantee? Because we don't know what the residual value will be 10 when we return the asset. Okay, yes, but remember now, we have to look into our crystal balls, and we have to say, okay, we think that probably at the end of the lease term, this asset is still going to have some value, and then we might be able to sell for 10 Rand. So it's the same as when you do a residual value calculation or estimate for any other PPE asset. You say, okay, I'm going to use it for 8 years or whatever, and after the 8 years, I think the value is going to be 10 Rand, and I'll be able to sell it for that amount. So it's exactly the same situation now. Now you're only giving it to the lessee to use for those 10 years, and then you're saying, okay, at the end of those 10 years, I'm going to get it back, and then I'm going to be able to sell it for whatever amount. Okay, so that's why the lessor in the interest rate implicit in the lease will include the unguaranteed residual value as well as the residual value guarantee, because this is saying at the end of the lease term, I'm going to get the full 10 Rand back, asset back. So we estimate the residual value will be 10 Rand, therefore we can use that as the future value. Yes, we use it as the future value, but we use it as 8 Rand in terms of the residual value guarantee and 2 Rand in terms of the unguaranteed residual value. Oh, was it 6 Rand and 2 Rand? Okay. Okay, cool. Whew. Okay, let's move on. Okay, we've already done that. Okay, so if we do not have this information, if we do not know what the unguaranteed residual value amount is, and we do not know what the initial direct costs for the lessor was, then the standard says, okay, in that case, go ahead and use the lessee incremental borrowing rate. So that is there for our second prize. Okay. First prize is if we can use the interest rate implicit in the lease. That's actually what we want. But if we don't have all the information, second prize is just use the lessee's incremental borrowing rate. We as the lessee will know what that is, so that won't be a problem. Okay, now you'll see sometimes in questions, sometimes in a question, we want you to use the interest rate implicit in the lease. Okay, so it's a lessee question. It's a lessee question. And we give you all the information you need to calculate the interest rate implicit in the lease. So what's going to happen now is you are actually going to have two fair value calculations. Okay, so you are first going to have to do a calculation where you calculate what the interest rate implicit in the lease is. So you'll have a present value, you'll have your so the present value will be the fair value of the asset. The future value will be any balloon payments, as well as then my unguaranteed residual value. You'll have your, what else will there be? You'll have your payment amount, and your term of the lease. And then you are going to calculate your interest rate. Okay. Now we have to calculate the lease liability for the lessee. So now what happens is we use this interest rate that we calculated over here in our next present value calculation, where we will use that interest rate that we used over there. So that interest rate. Then we'll we want to know what the present value is, because that will be our lease liability. Our payment amounts will be the same, but remember now we've got that difference here for the, we'll only include in our future value, it's part of the lease payment definition, but here we'll only include the amount payable in terms of the residual value guarantee. Whereas over here, we would have included the full residual value guarantee plus the guaranteed residual value. Okay, because that's part of my lease payment definition, the full residual value guarantee. And then specifically interest rate implicit in the lease calculation says we have to add the unguaranteed residual value. Okay, so watch out for that. Sometimes students don't realize, they see that there are two present value calcs and they don't know why do we have these two present value calcs. And the reason for that is we want you to use the interest rate implicit in the lease. So that's our first prize. That's the important, if we do have that information, that's the best rate to use. But that means we first have to calculate what the rate is, and then we are using it in our lease liability calculation. Good. Okay, so in example 1, that's exactly what happened. In example 1, they gave us interest rate. They gave us the incremental borrowing rate, so we didn't have to calculate the interest rate implicit in the lease. We are including, in this case, our residual value guarantee is 4.5. But we think the residual value is going to be only 3.2 million. So this is the amount payable in terms of the residual value guarantee. Our payment had a little bit of a trick there, where it seems as if it's going to be a variable lease payment because it's an amount per unit, if I remember correctly. However, there's a minimum amount. So this minimum amount is basically then as in substance fixed lease payment. Yes, so it's not a variable lease payment. It looks like it is, but the minimum payment is actually fixed. Lease term was 15 years. Interest rate is the incremental borrowing rate, and that gives us then our present value, which is the initial recognition of the lease liability. Okay. Now we go to the debit side. Now we've got the credit side, the lease liability. Now we go to the debit side. So that's the right of use asset. How do we calculate that right of use asset? So that we find in paragraphs 23 to 25. First of all, it says that right of use asset is first of all at cost. My cost. And what is that cost? And the standard says, okay, cost is made up of, firstly, the lease liability. So we would have credited the lease liability, and now we are debiting the right of use asset. But then we also have to add to that, we have to add any lease payments, less lease incentives that have already been paid at or before the commencement date. So this will, for example, be a deposit. If I paid a deposit, then that will be a lease payment that I've already paid. It can't be part of my lease liability because I don't owe that amount anymore. It's been paid, but it has to form part of the cost of the asset. So what's going to happen here is we are going to credit bank whether we've paid the deposit and debit the right of use asset. And the other way around for the lease incentives that have already been received. Okay, as well as any initial direct costs of the lessee. So again, we are going to credit bank, and the debit will go to the right of use asset. And then if there are any dismantling costs, anything like that, that we have to include normal rules, like an IAS 16 PPE asset, if there are any dismantling costs that we have to pay at the end of our use of this asset, that will form part of the cost of the asset. So there we will go and we'll say credit a provision for dismantling cost, and the debit will form part of my right of use asset. Okay. So question there from Mr. Mangali, is the initial measurement of the lease liability done from the perspective of the lessee? Yes, but remember that if we have the information, we will use an interest rate that's done from the perspective, calculated from the perspective of the lessor. However, our inputs, our present value, future value, the end, all of that will be from the perspective of the lessee. It's just the interest rate then will be my interest rate implicit in the lease if we had that information, and that rate was calculated from the lessor's perspective. Okay, so right of use asset, we now know how to do that. We know how to do our lease liability. So in example 1, there we had our right of use asset, started off with my lease liability. Then there was a lease incentive that has already been received. Initial direct cost that we incurred. And then the employee cost, watch out for this. The employee cost is not included because we would have in any way paid that employee's salary. So the fact that he spent some of his time on this contract is not an incremental cost. Initial direct costs are always incremental costs. Okay, so it's not all costs related to the contract. It's costs that I incurred because of the fact that I entered into this contract. Okay, so watch out for that one. There's the deposit paid to secure the lease. So that's a lease payment that was paid before the commencement date, before or at the commencement date. It can't be part of the lease liability because it's we don't owe it to the lessor anymore. And then the restoration provision. So there we calculate the present value of the restoration provision, and that's included then in the cost of the asset. Okay, and then the leasehold improvement costs. That's another one that you have to watch out for. So the leasehold improvement cost, you'll see later, that's actually a normal IAS 16 PPE asset. Okay, so the leasehold improvements are, for example, when we rent or when we enter into a lease for an office building, usually what happens is that office building is given to us, we only get the shell. So we decide ourselves how we want to use that building, that space in the building. Do we want all our employees to have separate offices? Do we want to have big open plan offices and just have the senior management in the separate offices? Do we want boardrooms? Do we want, what do we want? So what we do inside that building to set it up the way we want it to be so that we can use it, those drywalling and everything that we do inside that building, that's a leasehold improvement. And that is a normal IAS 16 PPE asset. That has nothing to do with the lessor. The lessor does not care about whether I have open plan offices or separate offices. It's nothing to do with the lease agreement. So that's our own assets that we put into place in that building and that we are going to use. So we are going to, and at the end of the lease term, usually what happens is we have to return that building to the lessor as an empty shell again. So that means we have to break down all the drywalling, everything that we did, to give it to them as an empty shell. So therefore, leasehold improvements are going to be an IAS 16 asset. And in this case, like for the office building, we are not going to be able to reuse that drywalling. So the lease term will also be my useful life for that leasehold improvements. So we're going to have normal depreciation over that term, everything like a normal IAS 16 PPE asset. Okay. Okay, Ms. Malloy says, I read in the standard. Oh, it makes my heart so warm to hear that you are reading your standards. Where it says lease incentives receivable are deducted directly from the initial measurement of the lease liability. Why is that the case? Okay, yes, so that is, if we go back to our lease liability, we said here that lease incentives that have not yet been received, that will form part of my lease liability measurement. So the case, I'm not sure exactly where you read this, but if that lease incentive is going to be receivable only in 5 years' time, like in the middle of the lease term or something like that, you will still include. You won't deduct it immediately. You'll deduct the present value from your lease liability. So you'll include it in your you'll have a little cash flow calc then to say, here's 1, 2, 3, and 4. I'm going to pay these amounts, and then in year 5 I'm going to pay my lease payment, but I'm also going to get an incentive, and then 6, 7, 8, 9, 10, and then all of that you work back to a net present value. So you include that, you deduct it from your lease liability, but you have to take note of when it's going to be received, because if it's only going to be received in 5 years' time, then you can't deduct that exact amount that you are going to receive in 5 years' time from the lease. Today you have to deduct the present value of that. Okay, will the question tell us if the additional amount of 250,000, which is the 2,200 units at 1,500 each, less the fixed payment, which is the variable payment, whether or not it's dependent on an index or rate. If it's dependent on an index or rate, what are the effects on our lease liability calculation? Okay, so obviously, do you agree with me that in this question, it was obvious that the variable payments were not linked to an index or a rate? Okay, variable payments were linked to the amount of units that was manufactured or whatever. Okay, so when a variable payment is linked to an index or a rate, that is to say, for example, when we have a situation where which is very common, where we link the lease payment to, for example, the inflation rate or something like that. So it's a rate that the lessee does not have any, not the lessee or the lessor has any control over that index or that rate. Okay, so if that's the case, then those variable lease payments are included. But the moment that we are linking the lease payments to something that the lessee or the lessor actually has control over, then it's not a lease payment in terms of IFRS 16. Okay, it's a variable lease payment, so it will not be included for my measurement of my lease liability, unless there's an in-substance fixed amount, as this is the case. Okay, if it is linked to an index or rate, it will be considered a variable payment, and this would form part of the payment. Yes. Yes. So we're going to still get to that. That's part of the subsequent measurement that we are going to do on Thursday. But yes, so that will be part of my payment amount. And we are going to say, if that's the case, say, for example, it's linked to inflation, we are going to say, based on today's inflation, on the commencement date, this is the lease payment, and we're going to include that in our calculation to calculate our lease liability. And then later on, when the inflation rate changes and our payment changes, then we are going to remeasure that lease liability. Okay. Are we going to remeasure? No, well, we'll get to that on Thursday. So I'll keep you in suspense over that one. Okay, if variable payments are based on index rate, then they are included in the measurement of the lease liability. Yes. Wouldn't it be included in the measurement of the lease liability as part of the payment in that calculation? Yes. That's what, yeah. So we will, when we measure our lease liability, then we'll include that. Cool. Thank you, Mr. Armstrong. Good. Okay. So we've measured our right of use asset. Now we'll just quickly have a look at the journals. So you'll see that obviously you could do this as a net journal, so you don't have to ask me that. But now you'll see that the lease incentive, the other leg was bank, and the credit goes to the right of use asset. Same with the initial direct cost. We credit bank and then we debit the right of use asset. There's the lease liability and the right of use asset. The deposit that we paid, credit bank, debit right of use asset, and the provision for restoration costs we credit and we debit the right of use asset. Okay, and then here we have our leasehold improvements. So the leasehold improvements we treat as an IAS 16 PPE asset, so it's not part of my right of use asset. Okay, so that means there's going to be in my PPE note, there's going to be a column for leasehold improvements, and then we're going to put those amounts in there, the depreciation and the whatever. Good. Okay, now subsequent measurement. If we look at subsequent measurement for the right of use asset, we treat it as an IAS 16 cost model. So we'll have cost less the accumulated depreciation, and then we'll have some remeasurement. If there's a remeasurement of the lease liability, then that will also affect the right of use asset. The other leg will go there, but that's what we're going to do on Thursday. Okay, now on depreciation, just note that when we have a situation where our lease term is shorter than our useful life, so the lease term is for a period, but the asset can actually be used for a longer period, then obviously the lessee is only going to depreciate the asset over the lease term. Okay, because for this period outside of the lease term, the asset will not be with the lessee anymore. So that's why depreciation is calculated on the shortest of the lease term or the useful life. Okay. IAS 16 revaluation model may also be used for your right of use asset, but for IFRS 300 purposes, we will only use the cost model. Okay, but if we make that decision to use the revaluation model, that decision has to be done by class of asset. And it's not compulsory. The fact that you have office buildings that are your own PPE assets and you revalue them does not mean that if you do have office buildings under lease contract that you have to revalue that right of use asset as well. Okay, so that's just with regard to the revaluation model. Okay, and then also remember that IAS 36 impairment will also apply to a right of use asset. Okay, so if we realize that our economic benefits that we are going to get from this right of use asset will be less than the carrying amount of the right of use asset, then we will have an impairment. Okay, subsequent measurement for the lease liability. We'll have our carrying amount of the lease liability. The carrying amount will increase with the interest for that year, and it will decrease with the lease payment. And then we will have our remeasurement that we will look at in Thursday's lecture. Okay, so in our splokkie, we'll have an interest expense, and all the variable payment portions of the lease payment will go to the splokkie. Okay, so let's quickly first look at the questions. What will happen at the commencement date when we recognize the lease liability and right of use asset if the lessor decides after the commencement to give us an incentive? Okay, it is never paid nor receivable at commencement. Okay, that will be weird because if the lessee was willing to enter into that lease without the lease incentive, then why would the lessor voluntarily pay a lease incentive? But if it happens, I don't know how we'll account for that. It will have nothing to do with the lease, with the lease agreement, because everyone was willing to sign on the dotted line without that lease incentive. So I don't know, a donation maybe, but it will not affect the lease. Okay, I think the point of incentive is to get you to lease the item, so it would be pointless for them to offer. But I may be wrong. No, Mr. McGregor. Mr. McGregor, you are not wrong. it could prompt us to lease again in the future. Yes, that's a good point. So the lessor might say, oh, this is a good lessee. Let's make it easier for them so that they can stay on. So, for example, what will happen is the lessor might say, okay, I am going to build some extra parking or something like that in the building. But effectively what they are doing is they are actually just adding on to their own asset that they actually own. So they make it nicer for the lessee to use that building, but they're not really paying an incentive. And if they do pay an incentive like that or something, then I think that will be seen like marketing cost maybe by the lessor. But still, again, does nothing to do with the lease agreement. Okay, so just if we look at our subsequent measurement journals, the only thing that I want to point out to you here is that you are allowed to do a net journal. Why is my, there we go. You are allowed to do a net journal for your interest and your lease payments. So normal amortization journal where you'll say credit bank, debit lease liability, debit finance cost. Okay, you are allowed to do that. Good. This is more step for step in terms of the IFRS 16 requirements, but you are allowed to do that net journal. What else? Oh, yes, and then also journal 14. So this is the variable lease payment. So that's the amount that we paid over and above the fixed payment. So there was our fixed payment, but we actually paid 3870,000. So this is the amount that we paid over and above the fixed payments because we made more units. So that goes straight to lease expense in the P&L and credit back. Good. Okay, so with regard to the recognition exemption, so that we find in paragraphs 5 to 8, remember that this is only available to the lessee, so not to the lessor. When we get to the lessor next week, these recognition exemptions are not available to the lessor. So it might be that we might think that if you look at all these requirements now for a lease liability and right of use asset and all that, you might think, oh gosh, that's a lot of admin just for a small lease transaction. So, and that's why the standard includes these recognition exemptions. So, okay, for certain leases, we agree that it's actually not required. We don't require you to go into so much detail for these type of leases. So, you as the lessee may choose to use the recognition exemption. What does the recognition exemption say? It says that for short-term leases and for leases for which the underlying asset is of low value, the lessee might choose not to apply the normal criteria for recognizing a lease liability and the right of use asset. Okay, so we find the definitions of a short-term lease in Appendix A, and it says that it's for a period of less than 12 months, and also the lease agreement should not have a purchase option. So it's really just leasing that asset for a short term. So that will be, for example, if we now go somewhere and we have to rent a car, we have to go to Avis, rent a car and get a car. That's for such a short term, it's maybe for a few weeks at the most. But there's no option that we're going to purchase that vehicle. So now to go into all this administration and all these entries and calculations for that short lease term, that doesn't make sense. So there we will opt to actually use the recognition exemption and so what happens is we just expense the amount that we pay. Good. And the same goes for a low value asset. So we find the guidance there in the B paragraphs. So for in order to determine whether an asset is a low value asset, paragraph B3 says that we determine value by looking at a new asset. So if we are now leasing computer equipment, what will the actual cost of a new laptop or whatever be for us now to determine whether this qualifies as a low value asset. And also it must be an asset that can be used on its own or with other readily available resources. Otherwise, it might actually be part of a bigger lease agreement. And should not be highly dependent or interrelated with other assets or other assets. And we should also look at the nature of the asset. Okay. So that's to determine if it's a low value asset. Important, we make the decision for a short-term asset we make by class of asset, whereas for low value assets we make that decision on a lease by lease basis. Okay. Then if we now choose the recognition exemption, then how do we recognize this lease? We'll recognize it on a straight line basis or any other systematic basis. So if our lease payments for the first few years are going to be very low, but then they increase again like a gym contract, I don't understand that. They catch you with that. First few months you pay almost nothing, and then after a year or after 6 months, then slightly with the big amounts. But anyway, if it's something like that, then where the lease payments are going to differ over the lease term, but the benefit you're going to get from these assets are actually going to stay constant, then we will actually recognize the lease payments on a straight line basis. But you know that. You were taught this in FRK 201. Okay, question there from Ms. Malloy. What happens if ownership transfers at the end of the lease term and the useful life of the leased item changes? Does the IFRS treatment of changes in estimates apply for the purpose of calculating depreciation? Okay, so I suppose what you're saying is we entered into a lease for 5 years with an option to purchase that we think we are going to use, but then obviously we will have to say, okay, but we are going to be able to use that asset for an additional 3 years after the lease term for additional 3 years. If now after the lease term we realize that no, we are actually going to be able to use that asset for another 5 years, that will be a change in estimate in terms of IAS 16. Because the moment we now, there's this offer to purchase and we exercise that option to purchase, then the right of use asset now becomes a IAS 16 PPE asset. Okay. Okay, so I'm not going to spend much time on the disclosure. So just go and have a look at those notes. I have it open here. So just go and have a look at those notes. What you'll see is, first of all, our right of use asset is a separate section of the note. We have all the income and expenses related to leases that we have to include in the note. And then for the lease liabilities note, remember that the lease liability note is not a reconciliation from opening balance to closing balance. The lease liability note actually looks forward to say what are the cash flows, the future cash flows for these lease liabilities going to be. Then there's some additional information that has to be given, and you also have to show the total cash outflow for leases for the reporting period. Okay, so that's disclosure. Okay, so this is just, let me just quickly check our time. Good. So also note, remember what you were taught in FRK 201. Firstly, about the lease components. So the lease components, where we have to decide, we have to look at a lease transaction, we have to determine what are the lease components and what are the non-lease components, and we have to split that. We have to split the lease contract between the lease components and the non-lease components. How do we do that? Which values do we use? That is also information that is given to us in the, I think it's in the B paragraph. Anyway, so to make lease components, we'll use the standalone price. So if I went to another lessor and I rented only this one machine, what would I pay for that machine? That will be my lease component 8. And then the non-lease components will be the standalone price or the aggregate for the remaining, the aggregate of, in other words, the total for all the other non-lease payments. So I do that to measure these different lease components and non-lease components, and I use those amounts, and then I take note of the relationship between these three amounts, and then I take my lease payment and I apply the percentages of these components. I'll calculate if this was 100 Rand and this was 20 Rand and this was 80 Rand, then obviously I have to take my total lease payment. Let's say my total lease payment was only 100 Rand. Then I'll have to say, okay, but my lease payment multiplied by 100 over 200, which is the total of these three standalone prices, gives me my lease component A's value, lease payment for lease component A. And then I do the same for lease component B and for the non-lease components. Okay. The lease term, okay, what about the lease? Oh, and then we have the practical expedient where the lessee again can decide per class not to separate the lease and the non-lease components. So the lessee might actually say, oh no, I'm not going to separate them, I'm just going to treat it as one lease component. So take note here between the difference of the recognition exemption and the practical expedient. So sometimes the recognition exemption is now where we say, oh no, we're not going to go through everything to calculate the right of use asset and the lease liability. We are just going to expense the lease payments, and that will be now for the low value assets and the short-term leases. We also call this sometimes the simplified accounting treatment. Okay, we find that in paragraph 5. Then practical expedient just says that instead of now separating the lease and the non-lease component, we just say, oh no, we're just going to treat it all as one lease. Okay. So take note of the difference between these two. Practical expedient we find in paragraph 15. And the recognition exemption or the simplified accounting treatment we find in paragraph 5. Okay. And in a question, I have to tell you that it was specifically selected by the lessee. Okay. Otherwise, you can't just assume that we are going to use the simplified accounting treatment or the practical expedient. Ooh, it's a lot of talking. Don't worry, we're getting to the fun now, because now we have revised the lessee and some of the general principles for the lessee and the lessor. Now we are getting to the tax treatment for the lessee. Okay, so now it's going to get exciting because this is all new to you. So before we start, I'm just going to have a sip of water, and I want you to just think if there's anything else that you want to ask before we move on to the income tax. Okay, I don't see any questions. Remember, you can post your questions on the discussion boards or email us at fik300@up.ac.za. And also just take note that we actually do not answer emails or discussion boards or anything over the weekends or at night. If we do that, if you see that you've received an email from FRK300 at 11 o'clock at night, then you should say, wow, they're amazing. Okay, so it's not something that you should expect from us. We will get back to you as soon as possible, but within work hours. But sometimes if we've got time and the question is a good one, then we'll answer it over the weekend or at night. And then you should think, oh, these FRK300 lectures are amazing. Okay, so income tax. So when we get to income tax, we are going to compare the accounting treatment with the tax treatment. Now, I've used these boring pictures for the accounting So that's the IFRS picture for accounting and the SARS logo for tax. I actually had much nicer pictures, but because of we are worried about copyright for recorded lectures, I've decided to leave them out. But basically, the reason why I started this session today, for those of you who joined late, before we started recording, I was playing some music on the for you guys. And I was playing the Rolling Stones, because did you know that if you go and you Google the most famous accountant of all time, then one of the names that will pop up will be Mick Jagger, who is the lead singer of the Rolling Stones. Okay, so Mick Jagger, when you look at him now, he definitely does not look like an accountant. However, if you take a look at if you know what he looked like when he was like 19 years old, when he started studying accounting, then you'll say, oh, okay, this looks like someone who could sit in a class next to me. Okay, yeah. So I'm not telling you now to leave your accounting studies and go and join a rock band. Okay, it worked for Mick Jagger, but it will not work for everyone. Okay, but but Mick Jagger actually studied accounting. He wanted to be an accountant, and then he met someone on the tube, on the London Underground, and he was carrying a Moody Blues album, Moody Blues music, so blues music, and they started chatting, and they decided to form a band, or Mick Jagger decided to join their band. So yeah, that's just some interesting trivia for you on the most famous accountant of all time. Goed, who never became an accountant, but at least he wanted to be one. Okay, enough nonsense. Let's look at the different treatment between accounting and tax. So what happens for tax purposes? First of all our lease contracts for FRK 300 will be lease agreements in terms of South African Revenue Services, which means that SARS is going to grant us, or the lessor will be seen as the owner. So the lessor will get a wear and tear allowance, but the lessee will get a deduction of the lease payment when it is paid. So full deduction of the full lease payment when it's paid. So from the receiver's perspective, the lessee does not have an asset. But from the lessor, from the accounting perspective, we have our right of use asset. So what's going to happen for tax purposes? We have our lease payment as a deduction, but for accounting purposes, we are going to have a depreciation on our right of use asset and a finance cost or interest expense on the lease liability. Yes, Ms. Todzeti, you can walk around with some music under your arm on the Gautrain and see who you meet up with. It will be an interesting experiment. But don't join the band. Stick with me. I'll make you famous. Good. So you see that we've got these differences, and then we will also have differences when we have initial direct costs. So initial direct costs for tax purposes will be deducted when it's paid, and we'll tell you that. We'll tell you in a question that the initial direct costs can be deducted at the date of payment. Whereas for accounting purposes, that initial direct cost is included in the measurement of the right of use asset. So therefore, it will be included in the depreciation. So can you see that what happens here is we are going to get a once-off or a deduction in the year that we pay it, but for accounting purposes, it's going to be over the lease term. We are going to deduct it as an expense as part of the depreciation expense. So that means that we actually we are going to have to make some adjustments in our current tax calc, and we are going to have deferred tax consequences for a lease. Okay. So if we look at sorry, where am I? No, I missed mine. If we look at a simplified lease agreement where our lease payments are 10 Rand over a period of 10 years, interest rate 12%, future value 0, present value, we calculate that as 5650. So that's our lease liability. So we're going to credit the lease liability with a 5650, debit the right of use asset, and then we are going to have depreciation over 10 years straight line on the right of use asset. So if we take this information and we do a deferred tax calc, then what's going to happen is we are going to have a right of use asset with a carrying amount of 5085 and a lease liability with a carrying amount of 5328. Okay, so that's how I got to my carrying amount for the right of use asset and the lease liability. Now I just want to go back, take away all my animation. Okay, so the right of use asset, if we calculate the tax base, it's an asset. So the tax base will be the amounts that will be deductible in future. Now, SARS sees the lessor as the owner of the asset. So therefore, the lessor will get wear and tear allowances. The lessee will get nothing. So that's why my tax base is going to be 0. That gives me a temporary difference on which I have a taxable temporary difference on which we have a deferred tax liability. Now, what do we do with our lease liability? What will the tax base be there? Tax base of a liability is the carrying amount less the amount deductible in future. What will be deductible in future? So for the lease liability, if we think about it, we are going to get a deduction of our lease payments. Full lease payments we are going to get as a deduction. However, if you think about how we account for that lease payment and the journals that we do, this is normal amortized cost liability. Where I have my, I'll credit bank with my lease payment, debit my lease liability, debit my interest expense. So that lease payment will always consist of an interest portion and a capital portion. Good. So that means that our lease liability actually is made up of all the remaining lease payments, the capital portions of these lease payments. So do you agree with me there that the amount that will be deductible in future in terms of all these capital portions will be the actual carrying amount? Okay, so because all of these capital portions are going to be deducted in future when we deduct the lease payment, because every lease payment is going to have a capital portion that we are going to deduct. That means that our tax base will be 0. Carrying amount less the carrying amount will be 0, and we have therefore a deductible temporary difference as a deferred tax asset. Okay, so if you look at the net, not net investment. If you look at the net amount, you'll see that we actually have a deferred tax liability of 68. Okay. For the right of use asset, why is the difference not exempt? Because it arises on initial recognition. Okay, that is a good point. Just remember again that we are not just blindly following the rules. The rules help us to get to the right answer in terms of our temporary difference and our deferred tax. So in this case, because of the fact that the right of use asset was not a standalone asset, when we recognize the right of use asset, we also actually recognize the lease liability. So these two go together. So therefore, I'll show you now, there is going to be temporary differences, and these temporary differences are not exempt. So remember, like I said, the rules and the formulas help us to get to the correct temporary difference. But in this case, this is actually something that there was a lot of uncertainty about the treatment of a right of use asset, the tax on that, the tax base of that. However, they've actually come out with guidance now to say specifically that the exemption will not apply because of the fact that it's not just the right of use asset that's recognized. So if you think about it, on day one, when that right of use asset is recognized, we'll go debit the right of use asset at, what was it? 5650, and we'll go credit the lease liability of 5650. So net, nothing was actually recognized. If you hear what my meaning, so So at initial recognition, there was an asset and a liability. So that's why the exemption does not apply. Okay. Good, cool. I see the smiley face. So if we now, like I said, I'm going to show you now that this deferred tax liability that we have of 68, actually that makes sense that we have it. Because we are now going to use the same simplified lease transaction, and I am going to just put it into see what our current tax calculation is going to look like for the 10 years of this lease transaction. So here again, we have our year 1 to year 10. We start with our accounting profit. Included in that accounting profit will be my depreciation on the right of use asset and my interest expense on the lease liability. So obviously I have to add that back. Both of these were expenses for accounting purposes, so I add it back to eliminate it, and then I deduct the lease payment of R1,000. Good. So, and I do that then for every year, and you'll see that every year the the interest expense becomes smaller and smaller. Oh, that looks like an error. But anyway, yeah, but the lease expense becomes smaller and smaller and smaller. The interest component of my lease payment becomes smaller, and the capital portion becomes bigger. Okay, and then we deduct our lease payment of R1,000. So at the end of year 1, what effectively happened was that we had to pay more tax. So these temporary differences in the current year resulted in us actually having to pay tax on a bigger amount than just a normal accounting profit. And we know that so this makes us sad, but we know that in future, because if we now add up all these amounts, although I think that's a little bit of a typo, but anyway, you can just go and audit me and check me. But if you add up all these amounts, then you'll see that we actually have a null effect over the 10 years. So that means in future somewhere, we are going to be happy, okay, because we are going to be able to pay tax on a smaller amount. Okay. So if we now go and we add up all these differences from year 2 to year 10, then we'll we'll get to the -243, and that 243 times 28% gives me 68, which is the deferred tax asset that we calculated in our deferred tax calculation over here. Deferred tax asset of 68. Good. Okay, so I see a lot of comments and questions and answering each other here. Are we adding back the interest because it was initially deducted? Interest is technically already included in the deduction we get for lease payments in terms of tax. So the interest, we had the interest deduction included in our accounting profit. So over there, our interest and our depreciation was included in that accounting profit. So now we have to add it back to eliminate the accounting treatment so that we can put in the tax treatment. We're reversing the accounting, yes. Why is the deferred tax liability not an asset since it's -68? It's a deferred tax asset. Sorry if I said liability, but it's a deferred tax asset. Okay, I might have just said the wrong thing. Okay, even though the lease payments with both interest and capital components, the R1,000 we deduct for tax contains both the capital interest portion. We can't deduct interest twice, yes. Will these specific slides be uploaded? I added this one today. But I did load the slides for I did load some slides for you for the lessee, which contains most of these slides. But this one was last minute this morning before my lecture edition. Okay. Why aren't we allowed to deduct the interest? Because the interest, exactly what someone here at the top said, remember that every lease payment actually has a capital portion and an interest portion. So we are effectively deducting the interest. Okay. But SARS does not see it as a deduction of interest, SARS sees it as a deduction of the lease payment, the total lease payment. Cool. If possible, could you please quickly explain the tax base for the right of use asset and the lease liability again? Yes, sure. So if we go over here, so the right of use asset, because for this asset we are not going to have any future deductions. We're not going to get any wear and tear allowances on this asset, because remember, SARS says, no, sorry, it's the lessor's asset. It's not your asset, so the lessor is getting the wear and tear allowances. So therefore, there will be no future deductions, and the tax base will be nil. Whereas with the lease liability, our tax base will now be the carrying amount of 5328 less the amount that will be deductible in future. So because this 5328 consists of all the capital portions, so the capital portions of my lease payments, we are going to get the full lease payment as a deduction for tax purposes. So included in that deduction is my capital, will be my capital portions as well. And this lease liability is made up of all these capital portions of my future lease payments. So that's why the amount that will be deductible in future will be the full 5328, giving us then a tax base of 0. Where did the 243 come from? That should be the difference between these two amounts. Okay, 243 difference again. Is a net calc. Yes, I was just doing it as a net calc. Okay, answering each other. Good. Could you please quickly go back to the slide showing the current tax and deferred tax consequences? Are you talking about this one? Ooh, this one. Ms. Liane, is that the one you were talking about? I'm so confused. Don't be confused. Where's the, I'm so confused. Please explain the part where we look at the current tax calculation. Okay, I'll do that now, but firstly, let's have a look at this slide. So what the receivers is saying, what SARS is saying is that we are going to get the lease payment, full lease payment we get as a deduction. And then we'll also get a deduction of any initial direct costs if we had any. Whereas for accounting purposes, what is going to go to our P&L for accounting purposes will be my depreciation and my interest expense for that year. Okay? And if we add initial direct costs, that will be included in the right of use assets, so that would also be included in the depreciation. Okay, so if we now go to our current tax calc over here, then we start with our accounting profit, and we'll say, okay, now let's eliminate our accounting treatment first. So we add back the depreciation and we add back the interest to eliminate the accounting treatment, and then we say, okay, for tax purposes, we get a full deduction of the lease payment. Okay. So, Tepiso, I hope that explains, that helps. Give me a smiley face if it does. Okay. If you have something like maintenance, non-lease components, what will the tax versus accounting treatment be? Okay, good question. If you have these non-lease components, then remember for accounting purposes, they will just be expensed. So let's say that we had, so the 1,000 Rand was for my lease component, and then we had an additional 100 Rand for my non-lease component. So what's going to happen is that 100 non-lease component will just be an expense for accounting purposes, and it will be part of my, you'll also get that deduction for tax purposes. So therefore, we don't have to eliminate that in our current tax calc, because the tax and the accounting treatment is the same. We leave it there as a minus, as an expense for accounting purposes. It's expense for accounting purposes. It's a deduction for tax purposes. So we don't have to make any adjustments for that. Okay. Okay, Tipisu, thank you. I'm glad to see that smiley face. I'm so confused. Don't start a sentence with, I'm so confused. That upsets your lecturer. Okay. Goed. We have 5 more minutes left, but I don't have anything else to tell you, except that I want you to go and have a look at the example 7 for Thursday's lecture. So go and have a look at example 7. That's the tax treatment. So it uses example 1's information completely as is, and then it just does tax for that. And then I want you to start studying for your CVs. And yeah, that's it. I don't think there are any other homework questions after today's lecture. Yes, so it's just example 7. Go and have a look at example 7, and that's it. Okay, let's see. More questions. Is the maintenance the same even if the practical expedient is applied? So the practical expedient, okay. So what you are saying is, if we now decide not to, for accounting purpose, yeah, it will be the same, because if we decide for accounting purposes not to split the but that's, yeah. For accounting purposes, we decide not to split my lease components from my non-lease components, and we just treat it as one lease transaction, then we are not going to have this non-lease component expense over here, because it's going to be part of, it will form part of my lease liability and my right of use assets measurement. So it will just be as if there are no non-lease components. It will just be as if there is just this one lease that I accounting for, exactly like we did over here. And remember, then the lease payment will then include the lease component and the non-lease component, but it will just, for receiver also doesn't split it between lease components and non-lease component. Receiver just says your full lease payment you get as a deduction. Okay, so if it's not split, then we'll have this situation. Just as it is there. If it is split, then we again do not have to make any adjustments in our calc. The only thing we have to remember now is that the 100 non-lease component has already been expensed, so therefore my lease payment over here should just be the lease component's lease payment, not the non-lease component lease payment. Okay, Mr. Schempel has left us. He's already studying. Good. Just to confirm for current tax, the lessor will get the wear and tear deduction and not have to reverse the depreciation on the asset. The lessee will reverse the depreciation but not account for wear and tear. Okay, so the lessor, you'll see when we get to the lessor, that the lessor is actually going to de-recognize this asset when it is leased out to a lessee. So that means the lessor is not going to have a depreciation expense, but it's going to get a wear and tear allowance. So there won't be any depreciation to reverse for the lessor, but there will be a wear and tear allowance. Okay, but we'll get to the lessor later. And the lessee will reverse the depreciation but not account for wear and tear. Yes. I'm sure the lessor will still be able to add back depreciation deduct to the wear and tear. You are correct with the lessee. Oh wait, never mind. Yeah, the lessor wouldn't be able to, as they are not using the asset. Okay, but remember, if the asset is used for qualifying purposes, then the lessor does get that wear and tear allowance. So you'll see when we get to the lessor, you guys are very eager to get to the lessor, that the lessor will actually get that wear and tear allowance. Okay, if the lessee applies the recognition exemption for short-term leases or low-value assets, will there be a deferred tax effect? Or will the tax and the accounting treatment be the same? You will see now when you look at class example 7, if we have the situation where our lease payments, if we have a low value asset lease, and our lease payments are 100 Rand in the first 2 years, and then 80 Rand for the next year, and 70 Rand for the last year. If we have a situation like this where we actually have to straight line the lease payments, then we are going to have some deferred tax consequences because of the fact that that SARS will actually deduct the actual lease payment, whereas for accounting purposes we will have a straight line expense. So there will be an amount prepaid or an accrued amount because of the straight lining that will affect my deferred tax. However, if it's straight the same 100 Rand straight through for 4 years, then you'll see that there will not be any deferred tax consequences. Okay. Or any current tax consequences, because whatever we deduct for accounting, we'll deduct for tax. Okay. Good. I don't see any other questions. I think I answered all of them. If I didn't, like I said, please send us that email. Go to the discussion board, and we will answer you over there. When Kuni, our academic trainee, comes back, we will be even more efficient on answering your questions on the inbox and the discussion board. But for now, he has to focus on his studying, so we are answering on that. Okay, when you say straight line in that example, you would add up the total cost and divide that by the number of years, in this case 4 years. Yes, correct, Mr. Armstrong, that is exactly what it means. Okay, let's see, if you have any other questions for me, you're welcome to post it. I am still going to be here. Otherwise, let's see if I can play you out with some music. Okay. Don't know if that is the right one. Is this the right Amapiano? Amapiano. Can't even pronounce it. Miss Malloy, you requested Amapiano. First I have to stop the recording.